Let's start with a new topic that is called reconciliation. Among the easiest topic, simplest one, and yes, marks are up for grab. First, what is reconciliation? The word reconciliation is not new for you guys, that is for sure thing. In CPD or in foundation level, you have done one reconciliation, and that is bank reconciliation statement. You need to prepare bank reconciliation statement when there was difference between balance as per cash book and balance as per passbooks. At that time you were aware that company was maintaining cash book and bank was maintaining passbook in their records. At the end of some period, when you find that your balance as per cash book is different from what bank is showing in its passbook, you used to prepare reconciliation statement. On the very same lines, we understand reconciliation in costing as when there is a difference between profits as shown by financial accounting and profits as shown by cost accounting, we have to prepare a reconciliation statement over here as well. So the fundamental point is we need to understand this topic of reconciliation when two conditions are met. First, profit, finance and cost. These two books are kept separate. And second, important one, when there is difference between these two profits. Let's understand how accounting systems are being maintained. That's my first point. See, financial and cost accounting system, these are the two broad accounting systems that we study in today's scenario. And this cost and financial accounting system can be maintained in two different ways. First way is integral accounting system. What is integral accounting system? As I told, there are two accounting systems broadly being discussed. One is cost accounting, another is financial accounting. One way to maintain both of them is to integrate them. What is the meaning of integration? I'm not talking about your maths, of course. To integrate means cost and finance, these two are put together. There will be only one guy who will be maintaining both the sets of account combinedly. Only one set of books of accounts will be maintained, combining principles of cost as well as finance. So integral can be defined as cost and finance are merged, they are integrated, only one book of account is maintained, and it goes without saying, if only one book of account is being maintained, there is only one profit that is being derived. And if there is only one profit in your company, how can you reconcile? Because when you want to reconcile, there has to be at least two things, and rather to be putting it more precise, there has to be two different things, which is not going to happen in integral accounting system. So that's one of your theory questions also. Reconciliation system or reconciliation statement is not required when company is following integral accounting system. Don't worry about this much. We'll have our next chapter, integral, non-integral, wherein we'll be discussing at very depth how to maintain integral accounting system, and the second, that is non-integral accounting system. What is non-integral? Exactly opposite to integral. In integral, what we do is, in integral accounting system, we combine cost and finance. We combine their principles. We maintain only one books of account. Exactly vice versa is non-integral accounting system. Under non-integral accounting system, we maintain two different books of accounts. One as per financial accounting and another as per cost accounting. Two complete books of accounts will be maintained by completely different people, and at the end of the year, both of them will prepare their own final accounts. What happens is, Finance account prepares its P&L balance sheet. Cost accountant has prepared its costing P&L, that is commonly known as cost sheet. And when there is a difference between your costing profit and your finance profit, you have to prepare a reconciliation statement. Fair enough? So that's another theory question for you guys. When do you need to prepare reconciliation statement? Let me put it in MCQ form. A. Integral accounting system. B. Non-integral. C. Both of the above. And D. None of the above. What should be your answer? Yes, you should say under non-integral accounting system you have to prepare bank reconciliation statement. Let's move on. As discussed, in non-integral accounting system, cost and finance books are kept separate. Two profits are derived, and when there is a difference between two profits, you got to prepare reconciliation statement. The question arises, we need to answer a big question, why there is difference between these two. What are the reasons because of which profit and cost accounting system differs? Let's go into the reasons, and the reasons can be broadly categorized into 4 parts. These slides talk about what I explained. Let's go to the next one, reasons for difference. Main reasons can be categorized into 4 parts. Few of you might recall because we have learned cost sheet. Few you will come to know over here. First reason. The first reason because of which cost and profit figures differ are financial incomes and expenses. We discussed in cost sheet. There are plenty of incomes and plenty of expenses which are regarded as pure financial incomes or expenses. Hence, cost sheet or costing doesn't record them. Example, profit on sale of assets, loss on sale of assets, profit on sale of investment, loss on sale of investment, dividend received, bad debt received, etc., etc., etc. Plenty. What happens with them is, financial accounting does record them because the purpose of financial accounting is to find profit or loss. But your cost accounting system records none of them. Because your cost accounting system is concerned with only one thing, and that is to find cost of product. We discussed in cost sheet the examples that just I spoke about, profit on sale of fixed asset, loss on sale of fixed asset, etc., etc., etc. They are not recorded in costing because they are not relating to your product. Now, for this chapter, our point is, let's say in a company, we have profit on sale of fixed asset rupees 1 lakh. What will be impact of it? Your financial accounting will record profit from fixed assets 1 lakh on the credit side of its P&L account. As a result, its profit will increase. But what in cost? Cost accounting is not going to record this transaction. As a result, your profit of cost accounting system will be less by 1 lakh due to this particular reason. And that's the first reason for differences between two sets of profits. Second reason. We understand second reason as stock valuations. What is stock valuation? Why there is a difference in stock valuation? We learned in cost sheet that in cost accounting, stocks are always valued at cost or NRV, whichever is less. In cost sheet, we learned in stock valuation topic that in cost accounting, your stocks are always recorded at cost. But right from 11th standard, in financial accounting, we record stock at cost or NRV, whichever is less. So there is a principal difference in valuing stock between these two accounting systems. As a result, let's put it in example form. There is a finished goods stock of 1000 units, cost of which is rupees 1 lakh. But due to some reasons, its NRV has fallen to 90,000 rupees. Now year is ended, your accountants are preparing their P&L account. On the credit side, closing stock. Finance accounting will record 90,000 because finance accounting follows the formula of cost or NRV, whichever is less. Cost was rupees 1 lakh, NRV is 90,000, so finance has to record 90,000, that is cost or NRV, whichever is less. Think about cost. What cost accounting will do? Cost accounting has a funda always at cost. Hence, finance has recorded closing stock of 90,000, but the same stock costing will record at cost and the cost is 1 lakh. So there could be difference between this reason, and that is stock valuation. Going to the third one. Third reason we understand as difference in accounting policies. This is a very general reason, and there is no proper explanation for this. It's a kind of general. Like, your financial accounting might charge depreciation on SLM basis. Your cost accounting might charge on WDV basis. Difference in accounting policies. And if depreciations are different, profits will be different, and we have to prepare reconciliation system. One more example is, your finance account can value stock on FIFO method. Your cost accounting may value stock at LIFO method. Again, difference in accounting policies, and your two profits might differ due to this system, due to this reason. And the last one, last but not the least, is we have, that is under and over absorption. Oh, absorption. Do you remember that? The chapter, first chapter, absorption. Yes. To recall you absorption in 2 minutes time. Recall our discussions. If you can remember, I've told you like that. Say there is a rent of rupees 10 lakh of this building, which is fixed. The issue is whether I get 10 admissions, 100 admissions, or 1000 admissions, that rent is fixed. And if the rent is fixed, the bigger question is how to recover that from the product, that is customers, that's you people. So to solve this issue, कि fixed cost को customer से कैसे recover करें, we understood one technique that is known as absorption costing. What is absorption costing? In simplest way, it is charging of overheads to the product, and in our simple language we say it is a process of converting your fixed cost into per unit cost so that it can be recovered from the product. How do you convert them in a fixed to per unit? The way to convert them is, at the beginning of the year, you make some budget. You make some budget about your overheads. You make some budget about the number of units that you might produce. And when you do budgeted overheads divided by budgeted number of units, you get your absorption rate, the rate that you got to charge to your product for recovering your fixed overheads. Now what happens is, let's say I have a rent of rupees 10 lakhs which I got to pay at the end of my accounting year. 10 lakhs is the rent. I have thought of that I will produce 10,000 units during the year. So, remembering the first formula, we say absorption rate is equal to budgeted overheads divided by budgeted number of units. That is 10 lakhs divided by 10,000, and we have it rupees 100 per unit. Now eventually what happens is, you had thought of you will produce 10,000 units, but at the end of accounting period you end up producing only 9,000 units. Consequence, from 9,000 units you have recovered 9 lakh rupees, that is 9,000 at the rate of 100, your absorption rate. So we can say you have absorbed, you have recovered, or you have applied 9 lakh rupees from your product or to your products. And as we discussed in costing subject, cost sheet topic also, that your cost sheet will always record absorbed amount of overheads. Why, sir? Because the purpose of cost accounting system is not to find profit or loss. Had it been, yes, I would have recorded 10 lakhs. That's my actual rent paid. But your cost accounting system has the ultimate and main objective of finding the cost of product. And you must appreciate, in your product, 10 lakh has never gone. What has gone into your product is only 9 lakhs. So cost sheet will record 9 lakhs. On the other hand, how much finance is going to write? Finance is going to write 10 lakhs. That's your actual rent. And finance is recorded rent of rupees 10 lakhs, whereas costing will record it as 9 lakhs. And there could be difference between these two, which we got to reconcile. So these are the main 4 differences that we understand for difference between cost and financial accounting system. Just try to recall whatever I said, and the future coming slides will talk about this in depth. So out of 4, let's discuss the first one, that is financial incomes and expenses. There are certain incomes of pure financial nature, like profit on sale of fixed asset, profit on sale of investment, dividend received, interest received, etc., 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 which finance does record, but we have learned in cost sheet that costing doesn't. Say for example, there is a dividend received to the tune of rupees 1 lakh. What's the impact of dividend received in both the books of accounts? So your financial accounting will record dividend received on the credit side. But your costing is not going to record because it is a financial income. As a consequence, what's going to happen is your costing profit will be less by 1 lakh as compared to financial accounting. And 2 profits might differ due to this reason, and as a result, we got to prepare the reconciliation statement. Like income, there are expenses of pure financial nature, like loss on sale of assets, loss on sale of investment, donations, income tax, dividend paid, interest paid, etc., etc., etc. On the same lines, finance will record it, but costing will not, and there could be difference between these 2 reasons. Fair enough? That's our first point of difference, financial incomes and expenses. Let's go to the next one, stock valuation. What is stock valuation? Costing and finance, both of them follow different set of principles as far as stock valuations are concerned. You know, finance has always got the formula of valuing stock at cost or NRV, whichever is less, whereas in cost accounting system we value stocks always at cost. As a result, what's going to happen? Let's say there is a finished goods stock with the company of 10,000 units, the cost of which is rupees 1 lakh. Cost of production 10,000 यूनिट बनाने की कॉस्ट है 1 लाख रुपए, but for reasons we don't know, its NRV has fallen to 90,000 rupees. Cost 1 lakh, NRV 90,000. How will finance value it? Finance will value it at cost or NRV, whichever is less, and that is 90,000. So in financial P&L account, you will find stock being valued at 90,000, but cost accounting has always got the formula, always at cost, and hence it's going to record at 1 lakh, that is the cost of your stock. As a consequence, now costing has valued your stock at 1 lakh, your finance is going to value at 90,000, and your profits will differ. Profit as shown in costing will be different from profit shown in finance. Due to this reason, And again, we'll be on task of preparing reconciliation statement. Let's go to the next one, that is the third one. Third one talks about difference in accounting policies. It's a very general common topic, difference in accounting policies. Anything. Finance can have one set of accounting policy. Cost might have a different set of accounting policies from what is being followed by financial accounting. One example is depreciation. Your financial accounting might charge depreciation on WDV basis, while your cost might charge depre on SLM basis. Due to these reasons, your profit could be different, and again we'll be on the job to reconcile. Fourth one, the last one. The last reason for difference is under and over absorption. First, what is absorption? We have done a complete chapter on absorption, that is absorption costing, our overheads chapter, which talks about recovering fixed overheads. How to recover fixed overheads. What was the issue at that point of time? The issue was, let's say I have rented this premise and it is costing me 10 lakhs. The rent amount is 10 lakh per annum. Now how 10 lakh per annum is going to remain? Whether I get only one admission, 100 admission, 1000, or irrespective of number of admissions, I have to pay 10 lakh to my landlord. But the bigger issue is how to recover that 10 lakh from you people, students. How to recover? We thought at that point of time, the only way out to recover them is, let's make some estimates at the start of the year. That is, absorption rate we used to calculate based on budgeted overheads divided by budgeted number of units. Say, your rent is 10 lakhs, but your rent is 10 lakhs and you have estimated that you might produce 10,000 units during the year. So you calculated an absorption rate that is 10 lakh divided by 10,000, and that's 100 per unit. That's basically absorption, charging fixed overheads to the products. And your fixed overheads will be charged to product at the rate of rupees 100 per unit. Now, at the end of the year, you had thought of that you will produce 10,000 units. And if you produce 10,000 units, at the rate of 100, you would have recovered 10 lakh rupees by the end of the year. Unfortunately, it didn't happen. You ended the year and you could only produce 9,000 units. Now what's going to happen? You have to pay actual rent of rupees 10 lakhs. Whereas in costing, so if you have to pay the rent of rupees 10 lakh, your financial accounting is going to write 10 lakh to the debit of its P&L account. But I explained you in cost rate how much costing is going to record. Costing will record 9,000 into 100, that is 9 lakhs, the absorbed amount. As a consequence, your finances recorded rent of rupees 10 lakh to the debit of its P&L account, and your costing will record only 9 lakhs, and the two profits will differ due to this particular reasons. Let's understand under our absorption by a formula. You can say actual overheads. In this example, it is 10 lakhs minus absorbed overheads. Absorb. How did we find absorbed in this particular example of ours? We said 9,000 units into 100, that's 9 lakhs. So absorbed overheads can be calculated as actual level of activity, that is 9,000 in our example, multiplied by absorption rates, that's 100. So 10 lakhs minus 9 lakhs in my example, that's 1 lakh. What is 1 lakh? See, 10 lakhs is my actual cost. I recovered 9 lakhs, so I recovered 1 lakh less. It's my loss. I've recovered less, or in other words, I can say it is under absorption. Take opposite example. Your rent was 10 lakhs. You made an estimate of 10,000 units, but with the grace of God, you could produce 12,000 units. What will happen is, even if you have produced 12,000 units, still you will pay 10 lakhs actual amount of rent minus absorbed, but you would have absorbed 12,000 into 100, that is 12 lakh rupees. 2 lakhs you have recovered more, that is known as over absorption. And to put it simple for you guys, we're going to say this way: actual minus absorbed. How to calculate absorbed? It is actual level of activity multiplied by absorption rate. That is, if positive, we call it under absorption, and if negative, we're going to call it over absorption.